Today, I want to talk about how Robinhood may be about to collapse, because just like regional banks, they're desperate for more cash. I also want to talk about what I think will be the next domino to fall, and how exactly this will lead to the squeeze. So stay tuned, and let's make some money. And now I'll dive straight in with the key information. So, Tony tweeted saying, just as a heads up to anyone using Robinhood, you can only withdraw up to $50,000 per day. And therefore, if you think you're safe depositing up to the claimed $1.5 million of FDIC insurance protection, just realise it'd take you over a month to get your funds transferred to a real bank. So funny enough, Robinhood introduced a new policy on the 17th of March 2023, the day that Silicon Valley Bank and effectively Signature Bank ended up collapsing. That new policy is that actually Robinhood isn't governed by the $250,000 FDIC limit, they're actually governed by up to $1.5 million of insurance. And that's because, as they say, they effectively split your deposits or sweep your cash into several banks between Goldman Sachs, Wells Fargo, Citibank, HSBC, Bank of Baroda, and US Bank. But obviously at the same time, you can only withdraw up to $50,000 per day, so your money's effectively locked away and it's quite difficult to access. Effectively, they're limiting withdrawals, just like Citadel and a number of other hedge funds have done over the last few months. Now, it also seems like very coincidental timing to introduce this new policy, or at least to send out an email to all investors and all customers, reminding them of this coincidental additional insurance. It seems more like a desperate cash grab to try and get more customers taking their funds out of large banks or even regional banks and depositing it with Robinhood instead. And that is why Robinhood is also coincidentally offering up to 4.15% interest on your cash balances. Which obviously, as Amanda points out, that's better than most bank accounts and even fintech companies too. So it just seems so coincidental that Robinhood is reminding you of this new insurance policy and is somehow paying crazy high interest rates to attract you to their platform. This obviously could be a sign that Robinhood's losses have got even worse. Obviously, Robinhood was doing well in 2020 and 2021, but ever since, every single quarter, their profits and revenues have been declining. Maybe it's at the point now where Robinhood is very close to a collapse and is trying to do anything they possibly can to get new money in the door. And Special Situations has drawn out exactly what's happening with these currently collapsing dominoes. Obviously, the Fed rose interest rates, which led to the collapse of Silvergate Bank and Silicon Valley Bank and Signature Bank, and now Credit Suisse as well. Obviously, I think the big dog or the largest domino to fall will be Citadel Securities. Whether Citadel is the next domino to fall in this chain, or whether there's a few more dominoes in between, I don't know. But it is showing the wheels are in motion and these dominoes are currently collapsing, and I'm sure there's bound to be more dominoes to fall over the next few weeks. And one of those potential dominoes, or just a force pushing against those dominoes, is the struggling hedge fund industry. We've had yet again another hedge fund, this time it's Hedge's macro hedge fund, which has just plunged 32% this month on bond moves. Again, it seems hedge funds are once again struggling. The S&P 500 isn't yet setting new lows, but because of the banking crisis and effectively the bond explosion, many of these hedge funds are also struggling again. And it seems the reason for these hedge fund struggles and the reason for the current banking crisis is, of course, retail investors. Now, obviously, I showed you this video yesterday when the chairman of UBS effectively blamed retail investors or the last year's social media frenzy. The chairman of Credit Suisse said that last autumn we had a social media storm and highlighted the changing environment in the market. And that storm had massive repercussions that were felt more in the retail sector than in the wholesale sector. So it seems that Robinhood could potentially be the next domino to fall. Or maybe it's going to be UBS if Credit Suisse's toxic positions are too much for them to handle. And if you haven't already, be sure to join me over on Moomoo, the sponsor of today's video, using the link in the description below. You can currently get up to 17 free stocks, entirely commission-free trading, free level 2 market data, and most importantly of all, Moomoo is very easy to use, it's very clear, they've got tons of technical indicators and advanced charting tools. And with Moomoo, they've also got entirely free 24/7 customer support, and you can also trade around the clock with their full extended trading hours. Alternatively, maybe it'll end up being Deutsche Bank instead, because their credit default swaps rose yesterday even more than UBS's did. I believe it was published some time ago that if Credit Suisse fell, Deutsche Bank wouldn't be too far behind. I assume Deutsche Bank has a lot of crossover with Credit Suisse in terms of the positions they take and in terms of the type of hedge funds they finance. Similar to how in 2008, Merrill Lynch ended up collapsing very quickly after Lehman Brothers and needed to be rescued by Bank of America. So it may end up being that Deutsche Bank actually ends up collapsing fairly quickly, potentially even before UBS, causing the next domino to topple. But I think that ultimately the final domino to fall will indeed be Citadel Securities to effectively reset the market making industry. And speaking of Credit Suisse, I wanted to quickly touch on Credit Suisse's OBV. Now I've touched on OBV on the channel before, but have mostly only looked at AMC's OBV and have never really compared it to anything else. So the OBV measures buying and selling pressure as a cumulative indicator that adds up volume on up days and subtracts volume on down days. So with Credit Suisse since 2006, obviously the stock has fallen from highs of around $80 to below $1 per share. This falling price was caused by there being more sales or more selling orders than there was buying pressure. And that's why if you look at the OBV, Credit Suisse's OBV has always been declining, but especially over the last year, absolutely fell off a cliff. Credit Suisse's OBV sits somewhere around negative 3.5 billion. That means there's been 3.5 billion more shares sold than there has been purchased. And that's obviously what led to the price falling from $80 down to less than $1 per share. Or looking at the last year specifically, down from I think around $10 to below $1. Now you may say, Tom, surely because AMC has fallen from highs of $70 to its current price around $5 or $6, surely the AMC OBV should look exactly the same as this and should be falling massively, right? Well, that's where it gets really confusing, because not only has the AMC OBV not fallen into negative territory, it's actually been increasing over the last 2 years consistently. Obviously back in June of 2021, AMC's OBV rocketed up, but it didn't just stay there and it didn't fall back downwards, it actually continued getting higher. AMC's OBV retreated to around 4 billion shares, but has since increased up to 4.6 billion. But as Simulation Ape Nation tweeted, he said the float is 515 million shares, but we've had about 9.5 times the float in buying pressure, yet we went from $77 down to $3.70 at the lowest. Again, I think this just really proves the existence of synthetic shorting and the existence that we are indeed correct and own the float multiple times over. So it just proves that at some point we will win, AMC will squeeze, and these shorts will end up being covered, provided AMC doesn't go bankrupt, which it stands no chance of doing. And now StockSense Frank asked the question on Twitter and answered it, saying when will AMC and Ape be valued higher? Effectively asking, when exactly will AMC squeeze? And he said it might go up when the people forcibly holding it down run out of a large amount of money. aka when those synthetic short sellers can no longer push the price of AMC down due to them being liquidated or just not having enough cash. And he said, we know the dam is cracking, as you may have noticed, by all of these dominoes starting to fall. He said AMC has a daily average of 588,000 FTDs, worth on average around $13 million every single day. But obviously right now, especially over the last 2 or 3 months, AMC has seen a significant increase in FTDs, especially last month in February when we saw over 10 million FTDs in a single day. And therefore I don't think it will be long until more users are receiving notifications just like this, with Ape reaching over $100 billion in market capitalization. This notification will put the price of Ape over $100 per share. Now that is exactly what I want to see for AMC and for Ape as well. And obviously if pre-split is hitting $100 per share, that means post-split it will be hitting $1,000 per share and hopefully even higher. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.